about the world of instant payments. Now, on the surface, this is all about making our lives easier, right? Faster transactions, less waiting. But as the source material we're looking at today suggests, some see it as maybe the first step towards a future with a whole lot more control over our money. So, is it convenience or is it control? Let's get into it.
I mean, it's a frustration we've all felt, haven't we? You can send a text message to the other side of the planet in a blink, you can stream a movie without waiting, but sending your own money from your bank to someone else's, it can feel like it's still traveling by a horse and buggy. It's a total digital paradox, and it's kind of weird when you stop and think about it.
And here is the official solution to that paradox. It's called FedNow. Basically, it's a major upgrade to our financial plumbing. It's designed to make payments between banks happen in seconds, not days. And that's a big deal. You know, think about a small business waiting on a payment so they can make payroll, or you getting paid the second you finish a job. It really is the kind of convenience we've been expecting for a long time.
Okay, but this is where the story takes a turn. According to the source material we're examining, this new system isn't just about convenience. It suggests that while FedNow is definitely not a central bank digital currency itself, it creates the perfect foundation, the rails and the plumbing, that could make one possible down the road. It's presented as step one in a blueprint for a really fundamental change in how money itself actually works.
So let's see how this idea builds from just a simple, faster payment system to something much, much bigger, the very future of currency. This is where the whole conversation expands way beyond just speeding up your bank transfers.
The key term we have to get our heads around here is CBDC, which stands for Central Bank Digital Currency. Now, this is not like the money in your Venmo balance or even in your regular bank account. That money is technically a liability of a commercial bank. A CBDC would be totally different. It would be a digital dollar issued by and held directly with the government's central bank. Now, to be fair, many people who support CBDCs argue that you can build strong privacy protections into them, but the source material we're looking at today really focuses in on the potential risks.
And this slide really highlights the huge difference that the source points to. Think about physical cash. When you use it, your transactions are pretty much anonymous and private. And there's no central server anywhere that can just, turn off the $20 bill in your pocket. But with a CBDC, the argument is that every single transaction could be traceable and recorded on a central ledger. And that creates the potential for a completely new kind of control.
This brings us right to the core concern that's raised in our source material, and that is the argument that this new kind of financial architecture could create an unbelievable system of surveillance, basically a permanent record of our entire financial lives.
Just let that sink in for a second. The argument here is that a fully digital centralized currency would create a permanent searchable log of every single transaction you ever make, from buying a cup of coffee to making a political donation. Every single one.
So, the implications that the source lays out are, they're pretty profound. In this potential world they describe, there's really no such thing as a truly private transaction. All your spending habits, the causes you decide to support, the groups you associate with, every piece of that could become part of a permanent government database that could be analyzed. So building on that idea of total surveillance, the source then presents its most startling claim. And that's the potential for a financial off switch, which would give us central authority the ultimate power over whether an individual can even participate in the economy.
This quote really gets to the heart of the fear. Imagine going to buy groceries and your payment is denied. Not because you don't have the money in your account, but because some algorithm or some authority didn't like a purchase you made last week, or a donation you made, or maybe even something you said online.
So how could this even work in practice? Well, the source lays out a pretty straightforward potential scenario. Step 1, a central system flags the transaction it considers undesirable. Step 2, it then restricts or maybe even freezes your account. And then, just like that, step 3, your ability to spend is completely cut off, not by a commercial bank, but by the ultimate monetary authority.
And this is where all the threads come together. The entire issue, at least as it's presented in our source, really just boils down to a fundamental trade-off. It's a classic dilemma, just reframed for our new digital age. So here you have it, the two sides of the coin as laid out in the material. On one side, you have the promise of a completely frictionless, instantaneous financial system. And that is a massive convenience, no doubt. But on the other side, you have this warning of a system that could enable total surveillance and centralized control over our personal finances.
And that really is the question that our source material leaves us with. As we keep moving faster and faster toward a completely digital economy, the convenience is obvious. It's right there in front of us. But these deeper questions about privacy, about freedom, and about control, well, those are the ones we all might need to start thinking about. Thanks for joining me for this one.